Hi, I'm Kevin Nunez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy. Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we explain money how it should have been explained to us. Alright, so let's talk about the state of capital. And as of market close last Friday the 13th, February 2026, the S&P 500 is flat year to date. Although you are seeing significant outperformance in specific subsectors of the S&P 500. Energy subsector up over 20% year to date as of last Friday. Materials, industrials, real estate all up double-digit numbers as of market close last Friday. The Russell 2000, which is a glimpse into roughly 2,000 smaller publicly traded companies, is up almost 7% as of last Friday. This tells me that investors are rotating out of the Mag 7 tech stocks that everybody knows and loves and are deploying that capital into the other areas of the market. This is healthy. The rally is broadening out. So by and large, this is a good thing. 2025 corporate earnings were pretty strong. Profitability was up on most of these companies. And that's largely because of the deregulation and the new tax code that was revised last year. The S&P 500 energy sector is up over 20% year to date as of last Friday, but it accounts for less than 5% of the S&P 500. So, this has been a long time coming. Investors have been saying that it's been underperforming the broader tech stocks and the broader S&P 500 for a while. So as of market close last Friday, value stocks have performed growth stocks year to date. Let's double click on that. Value stocks are stocks that investors believe are on a discount or on sale. But typically these are older, more mature companies that tend to spit off dividends or distributions and things like that. Versus growth company. A growth company is a company that reinvests their profits back into the business to help them fuel that expansion instead of paying dividends, instead of paying distributions back to the owners of the company. So again, the headline there is that year to date, value stocks have outperformed growth stocks, which it's been a while since the last time we've seen that. Precious metals are also up year to date, which if you've been following the content, you'll know that we've been bullish on real assets. This includes anything you can touch: energy markets, infrastructure, real estate. All of these things are benefiting from deregulation and a slight decrease in interest rates. Speaking of interest rates, as of last Friday, the 10-year ended the year closer to 4%, which is down from 4.22% just a few weeks ago. Again, this is important because the 10-year treasury is what is loosely tied to your mortgage rates, to your credit card rates, to your car loan rates. So it's important that we see the 10-year go down so that consumers can see savings on their monthly payments. So friends, now let's talk about the breakdown. And if you've been following the content so far, we've covered 3 out of the 4 major asset classes. We've spoken about cash, we've spoken about stocks, we've spoken about bonds, and today we will talk about alternative investments. Alternative investments are investment strategies that are not listed on stock exchanges. And because they're not listed on stock exchanges, they're not liquid like some of those strategies. Oftentimes, when you invest into alternative investments, your assets could be tied up for years, if not, more than a decade. So it's important that you understand the risk that you're taking. Alternative investments could include hedge fund strategies, investments in private equity and venture capital. It could be investing in real estate. But at the end of the day, these are all investments into private assets. And because these are investments into private assets, they don't have the same, direct correlation to the broader stock market, specifically the S&P 500 or some of those larger indexes that everybody knows and loves. So it's a great way to diversify away from the public markets, but you have to account for that illiquidity risk because, your money could be tied up for 2 years, 5 years, 7, 10, and in some cases up to 12 years. So you gotta plan accordingly for that. Now, some of the pros to alternative investments is historically it's outperformed the broader stock markets. And the reason is because the greater the risk, the greater the reward. Or in the hood, we say scared money don't make money. And because investors are locking in their money for such a long period of time, they expect to see larger, returns on their investments. They expect to see outperformance when compared to the liquid stock market, because what's the incentive for an investor to lock up their money for 10 years if they can just invest into the liquid public markets and when they hit the sell button get their money back in 2 days? So again, these are all risks that are important to know up front. Another benefit into investing into alternative investments is you may get access to companies that are private, and it's no secret that it's so expensive for a company to IPO and go public that they're staying private for longer. So by you investing into the private markets, you're getting in early enough where you might enjoy some of the economics of the appreciation, especially if the company ever goes public one day. Now, unfortunately, alternative investments have crowded out the everyday person. Alternative investment fund managers tend to only want to work with institutional investors. And that's because one, institutional investors write larger checks, and two, they don't need the money back for a period of time, allowing the fund managers that flexibility to take on longer term risk versus a high net worth individual that might not have that flexibility. And even if you are a high net worth individual, good luck getting access to some of the deals and some of the more high caliber managers, because their minimums are oftentimes into the tens of millions, sometimes into the billions. So, it's that structure that's crowded out the everyday person. Some of the downside to alternative investments is one, the larger minimums. Oftentimes you can't access those deals with just $10,000, $100,000. Another downside is the limited transparency. Because you're dealing with fund managers that are buying into private assets and they're not traded on a public stock exchange, oftentimes there's limited information. Another downside to investing in alternative investments is the difference in performance between managers, aka dispersion. There can be significant outperformance from an experienced manager that knows how to find, acquire, and build up companies versus one that's just getting started that's inexperienced. That could lead to a significant difference in performance, which could be catastrophic to a financial plan. Another risk to investing in alternative investments is the liquidity. If you need your money because you got to pay taxes or you're going through a divorce or just life is lifing, you may not be able to access that money. So at the end of the day, investing in alternative investments can be a great way to add some gasoline to your portfolio, hopefully get some outperformance, hopefully diversify away from the broader stock markets. It can be a pretty powerful tool when used correctly. I mean, it's worked for many universities and endowments for decades. It works right up until it doesn't. So it's important that you understand the risk that you're taking, the fees that you're paying, the holdings in the portfolio before you even make an investment. So at the end of the day, investing in alternative investments could be a powerful wealth generating tool. Historically, it's outperformed the broader stock market. It's a great diversifier. It's a great hedge against inflation. It's a great way to access deals you probably wouldn't normally have access to. So with that, hope you found this helpful. Thank you again for watching another episode of Invested in Us. We ask you to join us across all social media platforms at NJK Partners, or you can follow me directly at Kevin Nunez NJK. Of course, you can visit our website at njkpartners.com. Please subscribe to our YouTube channel. Please subscribe to our weekly newsletter, Invested in Us. Please, all that good and fun stuff. So with that, hope you have a great week and we'll see you again next week. Peace, y'all.